Well, some of that drive in that 10-year today was what we heard from a number of Fed officials. We heard from Atlanta Fed President Raphael Bostic, also Minneapolis, Fed President Neil Kashkari today, both discussing the stickiness of inflation and what that means for Fed policy. Bostic writing in an essay, quote, "I think we will need to raise the federal funds rate to between 5 and 5.25% and leave it there until well into 2024. We also heard similar hawkish rhetoric from the Fed's Kashkari earlier today.
So there's a lot of attention to the next meeting in March. Is it going to be 25 or is it going to be 50? I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's much more important than whether it's 25 or 50 is what we signal in what's called the dot plot.
Certainly that has been a focus, the dot plot here most recently. So 50 basis points looks like it could be back on the table. We want to bring in Aditya Bhave, a senior economist at Bank of America. Aditya, great to see you here. So just first, your reaction to what we heard from Bostic and also what we heard from Kashkari earlier today, that hawkish rhetoric once again.
Good afternoon. Thanks for having me. I think we split the difference between the two. We actually have 3 more 25 basis point hikes in our forecast. That would get the terminal rate to 5.25 to 5.5%. So that's a little bit higher than what Bostic has, but we're not yet ready to concede that the Fed's going to go 50 in March. So maybe a little bit less hawkish than Kashkari.
And of those comments, what really stood out to you the most? What surprised you? I think the one thing that stood out to me, Kashkari saying the bigger risk is not doing enough. They're not afraid to over-tighten. And, that's something we've heard from Jerome Powell from the very beginning. If they're going to make a mistake, it's going to be on the over-tightening side of the Fed statements today. What stood out to you?
To be honest, none of this was particularly surprising. I think the Fed understands now that inflation is fundamentally a demand problem. They can't hope for immaculate disinflation, as we like to call it, essentially help from the supply side, getting us all the way back to 2% inflation. That doesn't seem like it's going to happen. And as long as inflation is a demand problem and demand shows signs of being sticky, persistent, then the Fed has to keep tightening.
So then, Aditya, that begs the question, how high will rates have to stay in terms of the timeline of that higher for longer, something we've been talking about because of that stickiness of inflation? What are you predicting?
We have the Fed remaining on hold till March of next year, but I think it's better to think about the timing of Fed cuts more in terms of what it would take for the Fed to cut, so thresholds rather than a calendar date, right? So I think the Fed would probably need to see 3-month inflation coming in around 2%, particularly on the core. And the only way that probably happens again is that the Fed finds the point of pain for the consumer. And we seem to be some ways away from that. So our base case, again, has the economy going into a recession in the third quarter of this year. And in our view, that will help bring inflation back down to much closer to 2% by March of next year. But if you don't get that recession, if the consumer remains resilient, then the Fed will have to hike further and probably remain on hold longer.
And getting back to your statement about it being primarily a demand problem, what do you think needs to happen with the labor market in order to bring that inflation number near the target?
The labor market has to slow down. We know that job and income gains are a big driver of consumer spending, probably more important than some of the other stuff that gets discussed around consumer leverage and excess savings and so on. So the labor market has to slow down. We know that the break-even rate of job creation to keep the labor market in equilibrium is around 50 to 100,000 jobs per month. Well, over the last 6 months, we've been averaging 350,000 jobs per month. So we've got some ways to go in terms of cooling off the labor market.
Yeah, and we'll get another read on the labor market next Friday when we get February's numbers. What are you expected to see there?
We don't have a forecast just yet, but we don't think it's going to look like 517,000. I think there's good reasons to believe that last month's number had a significant noise component in it related to favorable weather, related to labor hoarding. So again, we don't have a forecast, but I would expect something more like the November, December numbers in the range of 200 to 300 rather than a 500,000 print again.
Yeah, I think that number shocked a lot of people. Aditya Bhave, great to have you, Bank of America Senior U.S. economist.